Everyone thinks they know what SpaceX is. A rocket company, a Mars company, Elon Musk's biggest dream, finally hitting the public market. But when SpaceX actually went public, investors weren't just buying a space company anymore. On June 12, 2026, SpaceX opened for trading on the NASDAQ under the ticker SPCX. The IPO, priced at $135 a share, opened at $150 and closed its first day up 19%, putting the company's market cap above $2 trillion. It's the largest IPO in history, bigger than Saudi Aramco in 2019, bigger than Alibaba in 2014, and not close to either. On paper, it looked simple. Buy SpaceX, own the future of space. But that's not actually what investors bought. Buying SPCX isn't just buying rockets. It's buying launch services, Starlink subscriptions, AI infrastructure, government defense contracts, and the future cash flows of several very different businesses, all bundled into one stock, because the same filing also includes xAI, the AI company that merged into SpaceX in February 2026, bringing along the Grok chatbot and the social platform X. Three businesses, three very different risk profiles, now trading under a single ticker. And once a stock this large lists, a lot of people end up owning a piece of it whether they chose to or not. Here's why. Vanguard, BlackRock, and State Street, the so-called Big Three, control a large share of all U.S. ETF assets. Roughly 1 in 4 shares of the average S&P 500 company sits inside a passive index fund today. When a company this size joins a major index, those funds don't debate whether to buy. The rules of the fund require it. Many retirement savers hold target date or total market funds without ever picking individual stocks. In practice, a large chunk of them will end up owning a piece of SpaceX without actively deciding to. To understand what's really inside this stock, you have to go back to a deal that has nothing to do with rockets at all. In 2022, Musk paid $44 billion for Twitter, renamed it X, and financed much of it with roughly $13 billion in bank loans led by Morgan Stanley. Rates spiked shortly after the deal closed, advertisers pulled back, and Wall Street was left holding debt nobody wanted to buy at full price. The Wall Street Journal called it one of the worst buyout financings banks had been stuck with since the 2008 crisis. That may sound like accounting trivia. It's not. By 2025, X's annual interest bill alone had climbed past $1 billion, more than the platform's advertising revenue could comfortably cover. That's a heavy load for one company to carry by itself, and under the corporate structure at the time, it largely had to. That changed in February 2026 when SpaceX and xAI completed an all-stock merger, valuing SpaceX at roughly $1 trillion and xAI at $250 billion, a combined $1.25 trillion. Musk described it publicly as building a vertically integrated company spanning rockets, satellites, and AI. Critics, including some pension fund advocates who later wrote to the SEC, argued the timing and structure also happened to move X's debt and legal exposure onto the one balance sheet large enough to absorb it just months before the IPO. Both things can be true at once. A strategic rationale and a convenient side effect aren't mutually exclusive. xAI's own valuation had already been climbing fast, from around $230 billion in a funding round in late 2025 to $250 billion by the time of the merger. That's a real increase, but not an outrageous one on its own. What is worth pausing on is how differently the market prices these businesses. A satellite company might trade at somewhere around 6 times revenue. A company labeled AI can trade at 40 or 50 times revenue or more. Combine an AI business with a satellite business before an IPO, and you don't just add the revenue together, you potentially change how investors value the whole package. Some analysts describe this as smart structuring. Others call it something closer to valuation engineering. Reasonable people land in different places on that. Whichever framing you prefer, the resulting numbers are striking. Analyst estimates put combined 2025 revenue for SpaceX and xAI somewhere between $18 and $20 billion. At the IPO's roughly $1.8 trillion valuation, that works out to a price-to-sales ratio in the neighborhood of 90 to 95, reportedly cheaper than some smaller space companies like Rocket Lab, but still far above what almost any company outside AI trades at. For comparison, Cisco peaked at around 38 times sales at the height of the dot-com bubble in 2000, before falling more than 80% and taking over 2 decades to recover. That comparison doesn't prove SpaceX will follow the same path. Markets and companies are never identical, but it's the kind of number that makes analysts want to look twice. Even before the IPO reached Wall Street, another battle was already unfolding in Washington. In May 2026, the AFT, a federation representing teachers' pension funds, wrote to the SEC raising concerns about SpaceX's board, noting that several members are close personal associates of Musk, and asking regulators to look closely at disclosure and governance issues before approving the offering. Separately, a shareholder advisory group flagged that SpaceX's filing didn't mention that several XAI co-founders left the company in the months right after the merger closed. None of this means the IPO was improperly approved. It does mean serious institutional investors were asking the SEC to look harder before it happened. There's also a structural detail worth knowing. SpaceX's auditor is PricewaterhouseCoopers, the same firm that audits Tesla, another Musk-controlled company that regularly shares executives, capital, and business ties with SpaceX. That overlap isn't against any rule, but when the entities checking each other's numbers are this closely connected, it becomes a little harder for outsiders to independently verify where one company's story ends and another's begins. None of this on its own means anything is fraudulent. Corporate complexity alone doesn't imply wrongdoing, but history offers a useful caution. Complicated, tightly interwoven corporate structures, even fully legal ones, can make a company genuinely harder for outside investors to evaluate. That was true of firms that later ran into serious trouble, and it was true of plenty of firms that never did. Complexity is a reason to look closer, not a verdict in itself. Then there's the competitive backdrop. For decades, the Pentagon leaned on having multiple suppliers for satellite and launch contracts, which kept pricing competitive. That balance has shifted hard toward one company. In 2024, SpaceX won roughly half of the national security launch contracts put up for bid that year, with its closest traditional rival winning a small fraction of that. Add up the market value of the largest legacy U.S. defense contractors combined, and SpaceX alone is now worth several times that total. When the government needs something in orbit quickly, there increasingly isn't a comparable alternative waiting in line. So what did people actually buy when SpaceX started trading on June 12th? Most assumed it was a rocket company. In practice, it's a satellite network, an AI company, a social platform carrying years of contested debt, a dominant defense contractor, and one of the most tightly interconnected corporate structures Wall Street has taken public in years. History rarely remembers opening bells. It remembers what happened after the excitement faded. If you enjoyed this story, subscribe for more documentaries about the people, companies, and decisions that changed business history. I'll see you in the next one.